Wall Street event. We're on, I guess, November 4th, the day after election, and at least my town is doing okay. Hopefully your towns are safe and doing well as well. This particular topic we thought is very timely. A lot of you have probably heard about SPACs, special purpose acquisition corporations. They've been all over the news. It's a little bit of a funny vehicle going public, a bunch of individuals going public. I actually did one myself. I did one in 2005 with some old clients of mine from Net2Phone, for those who know Howard Balter and Alon Slosky. We did a SPAC and they disappeared and now they've come roaring back. And I get a lot of questions. I'm sure the people on this panel get a lot of questions about it. So again, our role here for the YU Wall Street Group is to continue education. We're an institution of higher education, and when people are in the professional world, they still need to know what's going on in the world. So we pulled together a fantastic group. Gil Ottensoser from BTIG is going to be our moderator today. Gary Julien, who actually did a SPAC from Schulze Asset Management, is going to give, I think, a perspective that'll be interesting for what's it like to do a SPAC. David Sultan is on as well from Fir Tree, what it's like perhaps to invest in SPACs and different components of it. And Eric Gomberg as well is on, another banker who can go ahead and give some perspective about what is happening over here. And let me hand it off now to this great panel. I just want to do a little shout out to Gail Propp, who I saw signed in today. I hope you're well and look forward to seeing you maybe one day in person again, if we get to that. But let me hand it off to Gil.
Much appreciated. Thank you very much. By the way, I think I was an underwriter once upon a time in 2005 on that Elon Slasky SPAC. So I do remember
I think
that.
you were.
I think I was an underwriter, and I think David Sultan.
I was an investor. Remember that?
Adventure Partners, that was us.
So I do remember that. That's incredible. Very grateful to be asked to participate, in this panel, Yeshiva University. Very, very grateful. The agenda, whenever we do things like this, is just to try to make smart people smarter about the asset class, answer any questions, you may have, and also feel very grateful to have been asked, to participate with this group. Eric Gomberg, Gary Julien, David Sultan, all professionals that I've worked with, in the past, and we've done great things together. And I do think, having banker, investor, and sponsor, to answer questions, hopefully gives a great outline of what's happening in the market right now. It is going to be my intention to go through some statistics just to frame, the conversation. But maybe before we do that, Eric, do you want to formally introduce yourself, talk about Odeon for a minute?
Yeah, very briefly, I'm Eric Gomberg. I head the SPAC banking effort at Odeon Capital, which is a boutique investment bank. Been at the firm about 18 months. We've been a co-lead or co-manager on 5 IPOs in the last 5 months, have 3 IPOs on file, and a very robust backlog, and are active across the life cycle of the SPAC, from getting to know the sponsor very, very early in the process to helping on de-SPAC, to finding targets. And I probably bring something of a unique background in that I had my own fund and was on the buy side for about 12 years prior to coming to Odeon, and actually invested very actively in SPACs, consumed the product, and participated in pipes.
Gary?
Great. So Gary Julien, I work at an investment firm called Schulze Asset Management. I lead a SPAC that has an announced transaction, so we're going through the closing mechanics right now. Expect to close it in Q4 with a company called Cleverleaves. I've been on and off in the market in SPACs for over 12 years. And I actually helped lead a SPAC in 2007, kind of in the second wave. So I'm pretty familiar with the product, mostly as a sponsor. And obviously you've seen the resurgence of the vehicle as of late, which generally I think from an investor's perspective is great to see. So.
Talking about investors, David, you want to introduce yourself?
Sure. So just echo Gil's comments. It's great to Be here talking today about SPACs with the whole crew here from soup to nuts of every part of the process as far as people involved. I'm David Sultan, the Chief Investment Officer of Fir Tree Partners. We are a multi-strat value fund, been around 26 years. I invested in my first SPAC, I think 15, 16 years ago when Gil showed it to me. And it's been a great product ever since. And we've watched it evolve to become much more institutionalized now with really some of the leading sponsors in the world and banks and underwriters putting out product and do a lot of great things. And I'm sure the market will continue to evolve for the good. So
February of 2004, that's when David Sultan invested in the first SPAC. It was actually the second SPAC of the chain. By way of background, SPAC emanates out of the small cap, micro cap arena. That's where, SPAC comes from. In 2002, I had my own small cap, micro cap investment bank. I know the guys that invented the product definitively. It's a firm called Early Bird Capital. I'm grateful that at that point in time, they invited me to participate in that first deal, as an underwriter, and grateful that I could convince someone like David Sultan to take a shot on what at that time, and I'll echo Lawrence's comments, at that time might have been, a blind pool trading on the bulletin board, with all these rules and regulations and warrants. But we've come a long way. So let me try to frame the conversation if I can. Bring up a screen. Does that work? Someone whose mic's on, shared screen.
It works.
So I've been involved in SPAC literally since 2003 for 17, 18 years. And if hypothetically you had challenged me to put together this slide at any point in time till about 2000 and let's call it 18, 19, it literally would have read like a who's list of virtually no one you've ever heard of. Again, back out the Net2Phone guys, and once upon a time, there have been some great sponsors, Nelson Peltz in 2008. But to see what's happened now in the space, Teal Capital, Altimeter, Rivet Capital, Starboard, Magnetar, Dragoneer, Redbird, who rumored to be buying the Boston Red Sox, Ukaipa. Everyone saw when Bill Ackman did his deal. PIMCO as a repeat sponsor. Goldman Sachs as a sponsor. Renan Agus working on his second SPAC. This is page one. Perceptive. Larry Robbins at Glenview. Barry Sternlicht. Fortress. Chin Chu. Shamath at Social Capital. Deerfield. TPG Gores. Apollo. This is just a sampling of what's happening in this space. The level of sophistication that has come, to the asset class is really staggering, incredible. And I think the thesis that I go with, as a banker, is that it's a function of the asset class now being much better understood, where historically it's been misunderstood, and where there's now just an appreciation for the fact that a SPAC is really nothing more than an IPO alternative. It's a process. It's a process by which companies go public. So not meant to compete with private equity, not meant to compete with the M&A process. It's where companies that make a decision that they would like to be in the public domain, for whatever the reason, valuations are better, or perhaps they exist in a fragmented space and they want to use their public equity as currency to roll up the competition. But when they make that decision to be a public company, they now have choices. You can go public via the traditional process, a process that I'm sure many of you are aware of has been under attack for some time. S1, 3 years worth of audited financials, risk disclosure document, to some degree, a lack of transparency, how the process takes place, indications of interest, inability to use forward-looking guidance and projections, which is interesting because a moment after a company goes public, suddenly they can give guidance, they could talk about the next quarter, they could talk about accretive acquisitions that they might make. The SPAC process offers an alternative way to get to the public market, again, via reverse merger with what already is a publicly traded company. And it's debatable, what the advantages are, but I think a lot of companies, view sponsorship, as one of those advantages. Having guys like Gary Julien and his partners telling the market, we love this company, and let me tell you why we love this company. Increased transparency, because you have the ability, again, as a public company buying something in the private sector, you can give forward-looking guidance. You can give projections, which should accrue to the benefit of all market participants, as well as the company from a valuation standpoint. Full regulatory compliance. This product does not obviate the need to file, an S1. In fact, these guys put an S4 into the public domain. And we could talk about that, but that's like an S1 on steroids, 300 pages, the same 3 years worth of audited financials, risk disclosure document, etc. And then ultimately, you have this publicly traded pricing period where for 4 months, the market gets to trade the company on a pro forma basis with all the information they're looking for, etc. So I know I'm rattling that off, very quickly. Hopefully it resonates. Hopefully that makes sense. But I'll tell you who it's starting to make sense to. And, I flipped the slide. The private equity firms. The private equity firms now recognize that very often there are exits within their portfolio where companies go public, the traditional process. And now suddenly they're saying to themselves, you know what? Blackstone, Warburg Pincus, CVC, Bain Capital, Platinum, Silver Lake, they're all saying, you know what? If I take my company public and perhaps there's a sponsor that I can partner with them with, who can help these guys navigate their way through the public domain. Again, the ability to be transparent and to give forward-looking guidance. These are all things that could accrue to the benefit, of our business. So you've got these great sponsors. Now you've got the private equity firms that view this as a viable IPO alternative. You learn about you're reading about the pipes that are being done, the crossover investors. Fidelity, T. Rowe, Wellington, Franklin Templeton, Barron Capital, Neuberger Berman, PIMCO, Blackstone, BlackRock, all excited to partner with the private equity firms as they sell their companies as they take their companies public via reverse merger with sophisticated sponsors, and they want to be a part of it. And these are kind of like, I'm trying to explain all the different parties and the constituents, how they're thinking about this, SPAC process, an IPO alternative, and why it might be beneficial. Before I turn this over, just so you can have an appreciation for the numbers and what's really happening. So the top left corner, again, goes all the way back to the first SPAC that was done in 2003. 2004, there were 11 deals that went public. I think David Sultan at Furtree participated in all of them, if I'm not mistaken. But really, it's in 2017, 2018, 2019, where an appreciation for the product really began to reflect itself. 10 billion in 17, 10.7 in 18, 13.6 in 19. The column on the right is not a misprint. There have been 169 SPAC IPOs this year, raising north of $62 billion. It's a big number. We always look really closely at the top right corner. The top right corner is capital markets activity in the United States of America, all IPOs done in this country. So on two metrics, the amount of capital raised, as well as the amount of deals done in 2017 and in 2018, SPAC represented 20% of the market. In 2019, that number went up to close to 30%. There were 206 IPOs in this country and 59 were SPACs. And this year, the number's at about 50%. So 50% of all IPOs in this country have been SPACs. Again, but the thesis that I'm going with is that that's not a bad thing. That's reflective of the fact that the market now has a better appreciation for what's happening here, and at least I would not be surprised if that number continues to climb, because I'm not sure if the traditional S1 process really makes sense, as far as a way to take companies public. So hopefully that's a little bit informative, frames, the conversation. Again, Eric Gomberg has been doing a great job at Odeon. They've become a significant underwriter, a significant player, in the space. Eric, no doubt your phone is ringing off the hook. Sponsors, companies want to know how to get SPAC'd up and what they need to do to get into the game. What's that existence like for you? What is that existence like for you?
Yeah, no, I think you hit on a lot of the key points. It's been really busy. I think a tremendous confluence of events has driven really SPAC euphoria. Never thought a pandemic would drive euphoria like this, but the phone really is off the hook. I think some of the other drivers that have contributed to the excitement is we had some really high profile transactions even heading into the year, that coupled with really high profile sponsors, but whether it's a DraftKings or Virgin Galactic, things that captured investors' imaginations. I think that helped quite a bit. And the one other thing I'd point out is really the low interest rate environment, I think, has been very, very supportive of the SPAC opportunity. Again, the unit structure, the SPAC IPO, it's traditionally $10 in a unit, and for the unit you get a share and some sweetener, which could be a half warrant, a quarter warrant, whatever that may be. And the $10 goes into a trust account. So it's really a treasury alternative, a liquid treasury alternative with a kicker, with a warrant that's really tradable, that if the sponsor finds an exciting transaction, the $10 can accrue value, could go to whatever the market sees it fairly valued at, and you can always cash out at business combination. You could vote affirmatively for a transaction and still get your money with interest accrued to it in return. So in this low interest rate environment, it's very exciting for the IPO investor. But I'd also say that, to your point, that you can provide projections. We've seen a lot of companies that are either very low revenue or no revenue, where they can kind of point to their 23 or 25 or 2030 numbers. And obviously, when you discount back future cash flows in a very low interest rate environment, a lot of present value can accrue there. So we've seen a lot of EVs and healthcares and LiDAR companies that are kind of early or stage be able to access public markets. And again, when I'm hearing from targets who are looking at going public via SPAC, and they're thinking about maybe a Series D or a Series E and raising 200 million or 500 million or whatever the number may be, and they hear we're going to get public currency, we're going to be able to marry to a quality sponsor, a known entity, we're going to not have ratchet provisions, we're not going to have control provisions that we might with a PE or a VC. That's very, very appealing. And again, Gil, as you said, with the sophistication in the product, where the Wellingtons and the Fidelities and the Newburgers, who weren't playing pipes 2 years ago, have become standard players, and they can validate a transaction and bring certainty of deal close even before the business combination is announced. That's become very, very compelling to the market. And I think that type of sophistication is supportive of ongoing strength in the market. And again, it's going to take good sponsors and good transactions at the end of the day to sustain the market. But I don't think by any means the trends are a fad. I think it's become very, very institutionalized at this point and will increasingly be so.
Yeah, I think, hopefully that's not lost, Eric's point about how popular it's become, with pipe investors, and also just like the idea of partnering with tier one sponsors who have deal flow, who are in contact with companies that want to enter into the public domain, and the sponsor acts in that capacity, being able to, source, ultimately diligence, negotiate and structure some sort of a transaction and bring that back to the market and simultaneously raise capital for that issuer. I had the privilege of being an underwriter on Schulte Asset Management when Gary's SPAC went public about 1.5 years ago. So we've been an integral part of this process as well. But Gary, I remember the thesis at the time. You had a complete, perfect appreciation for what was happening in the market, assembled a great team, and went out there to execute in a specific domain. Do you want to talk about that, a little bit, the team construction and what you thought the opportunity was?
Sure. So the firm that I work for is primarily focused on distressed and event-driven strategies, and the firm's been in business for over 20 years, kind of under that theme and umbrella. And so we carry that forward into the theme of our own SPAC at the time of the IPO. The transaction that we have here is a cannabis specific transaction. When we went out, we didn't have industries that we were specifically going after. We're certainly not a cannabis-focused SPAC. But what attracted us, I think, to the industry is the challenge that cannabis companies have in terms of raising capital, which I think is why this particular target came to us and others to try to raise capital through the SPAC structure. And as a result, the valuation led by peers in the market became incredibly attractive. Like, had this company gone public, said differently a year ago, the company could have gotten $1 billion valuation, and as a result of the challenges that this particular industry has had raising capital, we've given an opportunity to the market to buy it for north of 75% less. And so that just in our roots of event-driven and some distress and certainly value investing, we think that creates appeal for our investors, and we feel comfortable that aligns very much with our overall theme. But I think as it relates to the industry that we've chosen to invest in cannabis, took a lot of work, to really get comfortable with the space and to get comfortable with how this particular company, our target, which is Clever Leaves, kind of fits in with that space. Which I think helped, which is part of the value, I think, of SPAC sponsors to begin with, to go to an investor and help them, educate them around the investment. Now, there's not perfect alignment of incentives here, which I think all, institutional investors are aware of, but someone who's really, there's a lot of value, someone that's been doing M&A, or investing for a lot of years and has really gone under the hood. And can share some of their views and their thesis, and certainly some of the risks and challenges. I think investors appreciate that, and I think that certainly makes it unique of a SPAC transaction, certainly relative to an IPO transaction, where in an IPO that leadership is void. So hopefully that's helpful.
That's great. That's great. And again, as you motor through that process, the task at hand in the public domain, everyone has much information as they're looking for to evaluate the transaction, trades on a daily basis. And again, at some point in time, a record date is set, the shareholder vote, and every investor is going to have the ability, to approve the deal and simultaneously, ask for their capital back. Investors, talking about investors. So David Sultan, you've been doing this for a really, really long time, quite literally since day one. You've watched the market evolve. You talk a little bit about what's happening now. Probably a good opportunity for us to also just talk about structure, the unique arbitrage that exists for investors. Perhaps why, great investors, great allocators like the YU endowment, like Aaron Harrington, needs to take this really, really seriously, looking to invest more capital with management.
Not to put you on the spot.
Just saying.
Listen, I appreciate it, Gil. The market, as Gil touched on earlier, was when he came to me with that first SPAC. Early bird capital invented the concept, and again, I'm assuming some basic working knowledge here that everyone has of SPACs, of basically give your money to the sponsor. If they don't find the deal, you get your money back, and so you have virtually no downside. In the olden days, that was not the case, right? But that's what makes them so attractive as an investment vehicle. From an investor's perspective, you have a free call option, right? You put money, it's in trust, no deal, you get your money back plus interest. If it happens, things trade up, and more you have warrants, they're worth something. And so there's a lot of embedded optionality. The structure has evolved, as Gil alluded to, over time, right? When he first came to me with this crazy idea, he had to not just give me my money, he had to pay me more money to do this, right? They used to put more money in trust and give a lot of warrants. And, in the olden days, there were sponsors we never heard of. We had to hire private investigators to make sure it wasn't fraud. And we've come a long, long way, right? And in the 90s or 80s, there were some problems, before we got involved. But as Gil mentioned, we've gotten to a point now where, whether it's Gil, Eric, Gary as a sponsor, meaning these are some of the best sponsors in the world, underwriters, people have been doing this. The number of warrants used to be more, they've come down to be less. What the trust can invest in is now better. SPACs in all sizes and flavors, little SPACs buying bigger things, meaning there's been a lot of different waves and cycles, and the product is constantly evolving, even aligning manager incentives. There's been some changes to make that better, right? And so the idea again is, how do you have a structure that is a biggest win-win possible for everybody involved here, right? So that the sponsor, like a Gary, comes and increases the likelihood of his deal getting done. So that's structure having potentially less dilution. Pipes, sponsor equity, Gil and Eric coming in and helping do their thing, right? We want a vehicle as well for the investor where, again, my downside is limited and maximizes my upside. So everybody wins. And I think the evolution just between structure, quality of sponsor, and now the acceptability on the other side, right? The reception of the SPAC coming and saying, I want to buy you. In the olden days, people would scratch their head and you'd probably have to spend 3 hours educating the target what a SPAC was. Right now, if Apollo or TPG shows up at your door and says, hey, I want to do a deal, you know, oh, SPAC, great. Meaning it's much more acceptable, known about, and really is an alternative, you know, as Gil and Eric talked about, is just, it's a different raise of capital, right? It's a different way to do it. And so for us as investors, we've just seen it become much more institutionalized, I think is the key word that I probably used 17 times, right? As far as just sponsor, underwriter, accounting firms, right? Legal firms, the trust entity, right? That the money is actually in a trust somewhere with JP Morgan that you've heard of. And the rule of law, right? That in the US or Cayman somewhere where if something goes off the rails, you can sue even if it's a foreign SPAC, right? It's helpful if they list in the US and the money's kept in the US. So I just think we've come a long way. And I think you've seen some real businesses, some maybe a little less real, but still exciting businesses, right? Being bought, which has created a lot of excitement in the space, which I think has attracted more capital. And again, I think we'll strike a proper balance. I think there was probably a headline today, Goldman saying SPACs have, you know, gorged too much, the market's saturated. My only point to that is I say $50–60 billion of SPACs out there. As I was joking before, Google added about $50 billion to its market cap since this conversations began. There are trillions of dollars in private equity running around. There are hundreds, if not thousands, of private equity firms and sponsors around the world. I don't think when you think about SPACs in the context of that, that is such a large part of the market that it can't be a sustainable alternative way to do deals. So I think they are here to stay at a different level.
We're going to talk about optionality in a moment, but before I move on from David, I just want to make sure part of what he was saying, you know, was clear. You know, we've been doing this for a long time, and the trade has always, you know, been centered around this theme of, you know, a great sponsor, their ability to source deals in the private domain and pre-IPO, right? Like you're embedded within the shell before the IPO is announced. But from day one, there was always an arbitrage that existed. The money is put into an escrow account. Back in 2004, 2005, David Sultan, Fertra used to make me get Continental Stock Transfer on the phone with them once every 3 weeks or so to confirm that the money was actually sitting there and nobody had, you know, taken the capital. You know, that concept still exists, right? David, can I ask you to talk a little bit about kind of counterparty exposure to, you know, a basket of treasuries, short duration treasuries, and maybe ask you what sort of leverage you're comfortable using in the transaction, what yield that might offer?
Sure. So I think this is another point to consider, given we think about SPACs really, particularly in this environment now, as a great fixed income alternative, right? It's something with yield. Generally, people start to do, I'll call it interesting things, to put it nicely, when in a yield-starved world, right? So when you start to not be able to get a lot of yield, you start to lever it up and to get more yield. SPACs lend themselves to being levered up, given the short duration and lack of credit risk. Sometimes people take that too far. Usually, at some point they do, and they will, right? That's how you can turn a 5–6% yield into a 30% yield, and that all works until it doesn't, right? So I'd say you can get a lot of leverage on these entities. It leads to buying opportunities, whether it's a March this year or after the financial crisis, early, 2016, when they were forced sellers, because people do this a lot on overnight repo leverage. It's not the best thing to do, meaning it's great when times are good. The only thing I'd say about this is we're very mindful when we do this is to have longer term committed financing, right? So we can have our cake and eat it too. We can take advantage of this as an asset class because my duration and credit quality is phenomenal. It's short dated US T-bills. But we like to do this in a prudent manner, right, where I can match my financing terms with the length of my asset, which is a great way to make money using leverage without blowing yourself up for the once in every 1,000-year flood that happens every 3 years.
Okay, hopefully that's clear and that makes sense, to everyone. But there's a clean arbitrage, that exists here. In some deals where the perception of optionality is greater, it's a bigger arb, and where it's less, potentially it doesn't, trade as well. So I put it back to Eric now, and I'm going to try to, incorporate Ben Samuels, who's at Cowen and Company now, previously was at Evercore, also knows the SPAC space well, encouraging us to talk about structural nuances. So, Eric, right, we've watched new issuance, certainly, this year in the month of October. In the month of October, 53 SPACs priced. 53 SPACs went public, raising over $18 billion. Again, in all of 2019, which was a record year, there were 59 SPACs that raised $13.7 billion. So October was quite the interesting, month, to say the least. We're at a point in time where we talk about sophisticated investors, sophisticated sponsors. Not all managers, not all sponsors are created equally. Can you talk a little bit about structure and some of the levers that might potentially change how the deal is presented to the market? Duration, warrant component, cash and trust. Can I ask you to talk about that?
Sure. So again, yeah, there's a variety of structures, and depending on the reputation, perception of the sponsor, the amount of sweetener and the terms around the structure are going to vary. So a sponsor who has had tremendous outcomes is known for having exceptional deal flow, the ability to consummate transactions, is attractive to targets. They're likely to offer or to be demanded by the buy side less of a sweetener, meaning, we've now seen fifth of a warrant deals. We've seen quarter warrant deals, and that was unheard of 12 months ago. And on the healthcare side, and it's been specifically healthcare to date, really kind of biotech and more kind of on the 100 million, 125 million, where we've seen even warrantless transactions, where it's a unit equals a share. And a lot of those are, I'd say, somewhat organized deals where they're buy-siders who want to come in and get that exposure to a sponsor who's perceived as extremely high quality. By the same token, at the other end of the spectrum, you can play on duration, and a shorter duration means that the potential liquidation, the potential redemption comes sooner, which kicks yield a bit higher. So we can see terms where it's 18 months or 12 months, but what's become more predominant is on average 24 months and say half a warrant. But other ways to sweeten the structure for an investor would be to add capital to the trust. So instead of putting $10 into a unit and having $10 against it, the sponsor overfunds the trust and puts in 1010 or 1020 or even more than that. And I think we're likely to see more of a bifurcation in the market, given what has become, I don't know if I think currently we're at a point of saturation. I think the market will digest. Right now there's $13.7 billion in S1s publicly on file. And that's down from 18 billion about a month ago. So that number's been coming down. Fewer S1s are getting filed as the market is digesting. But the number of S1s on file is above the entirety of all capital raised last year, above the 13.6. And we're looking at like 5x the amount of issuance this year. I don't know that we could grow fivefold next year. I don't know that we could grow twofold. And part of it is, as much as Fir Tree and others are doing well, I don't know that their capital base is growing by leaps and bounds. So unless we see new entrants on the IPO side, or sovereign wealth funds or other funds starting to play IPOs in a sustained and sizable way, I don't know that 63 billion of issuance becomes 100 billion or 200 billion, although it probably does grow given the attractiveness of the product. So in terms of bifurcation, I think if you're a very high quality sponsor, if you're someone perceived as best in class, there is going to always be a market for you, or almost always going to be a market for you. And most investors, I believe, would prefer to play a top tier sponsor with a quarter warrant than a second tier sponsor with a half warrant, because who's the one who's likely to get the better deal and have a bit bigger upside to the opportunity. And I think if you're kind of in that second or third tier, you may be put in a position, and it's still very attractive from a sponsor perspective, where you give up on duration, where you go to 18 months, where you put 10-10 or 10-20 in trust to get a transaction done. But I think we'll see the spread kind of between the haves maybe and the have-nots in terms of structure. And clearly the market rewards experienced sponsors, name brand sponsors, people with that operational expertise where they bring unique knowledge. And I tell any sponsor, like, why are you more likely to get a deal than any other sponsor? And what's your edge? Why does the target want to transact with you? And if you can answer that in a compelling way, you're probably bucketizing yourself in the higher end of the market if you're seeing things honestly.
It's great. I'm going to turn this over to Gary in a second, because I want Gary to talk to what's going on now that there are so many sponsors running around, with SPACs. How does that change the landscape for what SPAC sponsors are trying to, accomplish? But I do want to address one comment that Eric mentioned. So, this is a chart that, we continue to sort of populate and build. Earlier in the month of October, our firm participated as a joint book runner on a deal for Peter Thiel. Peter Thiel partnered with a guy named Richard Lee out of Asia, who's Li Ka-shing's son. We raised close to $600 million in their SPAC. And we had over 130 unique institutional orders. Eric mentioned, right, that, what's happening and what has to happen is the universe of investors has to continue, to grow out. The comment here is that it is, where this once upon a time was dominated by, firms like Fairtrade, smartest guys on the planet, recognized that this was a structured product and an arbitrage and optionality. That universe has expanded now to where you do see insurance companies and endowments and foundations and investors that are just fundamentally biased and focused. Large family offices, are all, looking, to step into the arena, and buy SPAC. And the other comment I will say about deals getting done on the back end, we talk about how much new issuance there was in the month of October. Again, 53 SPACs. But I draw your attention to the lower part of this slide. 11 business combinations closed. 11 companies went public, finished the process, right? Went public via reverse merger, with a SPAC. Some are trading better than others, but this was the process by which they got to the public markets. Hyliion, electric vehicle company, stocks trading at $19. Churchill 3, Michael Klein bought Multiplan for $11 billion, not trading as well. The market, looking to find, a range. It's split. 6 of these things are trading, north of 10, $11, and 5 of these things are trading, somewhat below. I think this will just continue to evolve. The market will get more accustomed to seeing how these are, supposed to trade, once you emerge out of the back end of the SPAC, process. Hopefully that's helpful. I do want to, throw this over to Gary. We keep talking about how much new issuance there is, in the sponsor community. How does that affect being a sponsor? Schultz being a repeat sponsor, hopefully doing SPAC 2, SPAC 3, SPAC 4. Right. How's the competitive landscape shifting with all the new issuance?
Look, I think without question, given the just in the October volume, you have 50 SPAC IPOs and 11 consummated transactions, and so an imbalance of volume and an imbalance in terms of capital Invariably for sponsors, it's gonna, it makes the job, more difficult. And so, I think what happens in 2021, that chapter is yet to be, stories yet to be told, that chapter's yet to be written. But I think it's gonna be fascinating. And so what you're seeing, although because we're we're not out there with the second vehicle under our brand today, we are aware of, there are more bespoke SPAC bake-offs where you're hiring either a boutique M&A advisory firm or a Goldman or Morgan Stanley, and as opposed to going out to the private equity market to seek highest and best, you're actually doing a similar transaction focused on SPAC, IPOs, or SPAC back-end M&A. And so I do think it's going to get usually more difficult. And those that are best of breed, I think, are going to be, continue to be successful doing it, I think. But what's important, I think, as a result is because more private companies or more sponsors of private companies, private equity firms, are looking to take their companies public through SPACs as opposed to maybe outright selling them or taking them public. I think that is ultimately great for those companies, because I do strongly believe that being public for companies is better than being private. And I do think for those like David at Furtree, I think it's better for investors overall to have more selection, more competition. The dilution comes down. The quality of those companies are better, and the qualities of the sponsors behind them ultimately are better. And so the strong will survive. And I think what is best for public market investors will be best for SPACs. And I think those that hang around the longest will continue to do well. I think it's the first thing. And then I think the second thing is, look, I think a lot of SPAC sponsors do it because of this perceived notion of the value of their underlying sponsor equity. I think those that pursue it just based on economics is the wrong reason to do this, because the amount of work and dedication you have to have is pressure is immense. So you really have to want to do it for, I think, the right reasons. But I do think that level of promote, as they call it, or sponsor economics, I think that will come down. And look, ultimately, I do think that's good for investors, and so that'll perpetuate the product, and we'll continue to improve. And but I don't think that all SPACs that are going public today will find their deals. I think the liquidations will increase, but I think more successful business combinations will occur, which on the whole is good for the product. And for investors like David, the worst thing that can happen is their opportunity cost of capital. They could have invested somewhere else, but they will not lose money. So
I do agree with that comment, and maybe Eric will get your opinion also, that not all sponsors, are going to ultimately, find deals. But I do want to talk about the structure one more time for a moment. And I'm actually going to try to address Yona Lloyd's question. Everyone can see in the group chat, there are, questions being asked. And he's talking about a specific transaction, Desktop Metal, which I actually know well because it's going to a deal called Trine Acquisition, a guy named Leo Hindry. We were the lead book runner on that transaction back in March of 2019, a $300 million raise. Desktop Metals is, definitely a looking forward story. The company was able to be valued on 2023, 2024, 2025, revenues. And the comment is that is something that this structure actually allows for. I think a lot of bankers believe, a lot of sponsors believe, that because you're a public company buying something out of the private sector, or the effective process is making an acquisition, the public company, the SPAC, has the ability to use forward-looking guidance and projections in order to get valuation for these businesses. That expands the scope of what is considered IPO ready. I think historically, the traditional process has forced companies to fit in a box as far as what you've done the last 3 years, what your revenues look like, the trajectory of your growth, etc. And if you didn't fit in that box, you could not go public. But suddenly the SPAC process, allows for a little more flexibility, allows to tell a story and put in print and put into the public domain guidance that maybe supports, Desktop Metals, at $2 billion. I'm in agreement that there are a lot of, big stories being told, electric vehicle stories, comping themselves to Tesla or attempting to, that are coming through, the back end of the SPAC arena. And it remains to be seen, how these will ultimately work out. Just as a reminder, every investor has the ability to take their money back. You don't have to be long Desktop Metals when the vote takes place. So that just is something that, market participants make the decision they want to stay long or not. Eric, are you seeing something similar? Are your sponsors similarly increasing the scope of what they think is IPO ready and what is not?
Yeah, no, I think that's right. And our sponsors in general have been sector specialists and kind of operators. And so I think in most cases have, I think, something of an edge in terms of the opportunities, or at least what they could say that they bring to the table. And I agree with your comment, Gil, that, it's yet to be seen how some of these stories that are 24 and 25 and 26 stories actually play out. I think I bring some healthy, I don't know, skepticism, but, wait and see how they all turn out, because, some of them may just be stories and some of them may be wonderful growth opportunities that are around for the next decade. I think that the thing that's really interesting in this period, and we talked about, some saturation on the front end, and I hear all the time, are there too many, is there too much paper? Are there too many guys looking? And I think if you don't have some edge, it's going to be very competitive. And in the old days, a bake-off was the kiss of death, because you don't want to be the high bidder if you're a SPAC. You want to be bringing something at a discount to peers, public comp. So if you're paying more than any other sponsor, you're paying too much. I think if you have kind of sector specialization, and again, if I'm representing a target, I kind of want best bid, not necessarily high bid. I want the best path to where value will be when the stock, when my stock, if I'm the target, where that stock's going to be when lockup expires. But I think in terms of saturation on the back end, if you ask the average private company 12 or 15 months ago, do you want to go public via SPAC? I think probably 98 out of 100 would say, what's a SPAC? And the other two would say that's kind of last resort. And I think today, if you ask privates, I think its magnitude's different. So while we're at $62 billion in issuance today versus 13 and change last year, I think there's hundreds and hundreds and hundreds of billions of privates of market cap that are now willing and maybe even eager to transact with sponsors. So I think, it's a very, in certain situations competitive, but I think very, very fertile. So if you're, in the market as a sponsor, I think there's never been there may be some stories that don't pan out, but I think there's also some very real and compelling opportunities that are now willing to go the path, willing and eager to go the path of merging into a SPAC. Whereas I was, far from the case even 12 months ago.
Yeah, listen, willing, eager, attractive opportunity. Lawrence is asking the question again, because I think this is the right point, that Eric's trying to make and that Gary was making. How does a SPAC differentiate itself in a SPAC bake-off? I talk to sponsors and investors and companies about that, hypothetical hospitality business at an inflection point that has made the decision that they want to be in the public domain. So it's like the traditional S1 process, or, maybe let me go meet Barry Sternlicht, right? Like maybe by virtue of the fact that I reverse merge into a shell company, a vehicle that Barry Sternlicht is the chairman of, perhaps that answers a lot of questions for me as I transition from the private sector into the public sector. Perhaps he's able to lower my cost of capital. Perhaps there are accretive introductions and acquisitions he can guide me towards where, I don't need him to be the CEO of my company. I'm probably a pretty good CEO myself if I'm at that point ready to go public. And, I may or may not need him to be my chair or my non-exec chair or a board member or a consultant and an advisor, whatever it might be. But there's an advantage, or a perceived advantage of taking my company public via reverse merger, with his vehicle. Gary, as a sponsor, right? I think Lawrence is asking you the question, like, what is the expectation of how the SPAC sponsor is expected is to differentiate himself, when he's a part of one of these big offs?
I think it depends. Someone like that, certainly, is on the. I think Eric described, the tier A and probably the tier A, the top tier of the, of the tier A sponsors. The vast majority are, have been successful doing certain things and, private equity, M&A, or just running public companies. But I think it's harder, and so I think so how does one bring an edge to the transaction? I think the biggest edge is bringing committed capital, and so if you can bring committed capital to a transaction outside of there's certainly a pipe opportunities and that is a form of committed capital. But if you can draw down out of your fund, I think that puts a competitive advantage. I think that's number one. Number two, having an industry expertise that you've been there before, you can help them build their business. I think that is incredibly compelling. Number three, you hung around the hoop on this product sometimes. This is the transaction has been described to me as three-dimensional chess. They're very complex to bring to fruition, and so those that have been there before. And their prior track record either speaks for themselves or adds a good reference. I think is incredibly helpful. And I think, look, those that understand how how the founder's equity can be used as a tool to align interest and maybe mitigate dilution, I think it'd be helpful as well. So I think it's there's no perfect answer, there's no silver bullet, but some combination of the four. And I'm sure there are others. I think help allow firms to differentiate themselves. So.
All right, I'm not sure if there are any other questions. What I definitely wanted to hit upon in the last couple of minutes that we have is where is this thing going at this point in time? In 2020 here, we've had more new issuance this year than in the history of the asset class, an asset class that takes you back as far as, again, 2003, 2004. As an investor, David, what are you thinking? Where does this go? Into 2021, 22, et cetera.
So, listen, again, I come back to the word I keep using, institutionalize. Institutionalize, it's here to stay, right? Will there be cycles, as I think Eric alluded to earlier, the amount of deals in that filed S1s in the pipeline has actually come down a little bit, right? The market needs a little bit time to digest. And I think the thing that Gary mentioned as well is there are going to be a number of these sponsors who fail, right? Right now, the hit rate is super high, meaning 80, 90% are closing. Traditionally, it's, probably closer to 50, which is still pretty darn high, right? And so I just come back to, you've got the best sponsors ever, the structure is the best it's been. Yeah, there'll be some folks who jumped on the bandwagon because it's easy, right? It's easy to raise the money. The hard part, as Gary can tell you, is getting the deal done, right? And Eric and Gil know this as well. That's the real work. And so I think some folks will say, this just wasn't worth it. Too much time, distraction, effort, too hard. I'm done, right? And some will say, this is a great new product. It works. You have a number of serial SPACsters who are on their fourth, fifth, or sixth SPAC. And yeah, I forget who said it earlier. The names, it's like a joke. It's SPAC number one, SPAC number two, my fifth SPAC, my sixth SPAC, my seventh SPAC. But at the end of the day, no one cares, right? They're investing in the sponsor. And so I think the market's here to stay, right? Will it continue to evolve and reform? Of course. Do I begin to now call this an asset class? I think, which heretofore I was a little bit more hesitant to say it was an actual asset class. And now I think it is, right? Have we gone a little nuts? Yeah. Will it control itself? Sure. Have we bought some electric vehicle companies, right? Someone asked again. I don't think it's an issue of the SPACs. I think it's a function of the market we're in, right? Meaning there are plenty of other public companies that have ridiculous valuations. But if that's the kind of growth market we're in, where rates are zero forever, right? Like sort of like 98, 99, and that's what the market's taking. Great. Traditionally, though, there've been a lot more just private equity deals, and it's a good sponsor, and they're buying a business at a reasonable price. And we're going to start to see more of that, given the, I think, thousands, if not tens of thousands, of private equity funds with deals they got to sell, right? Meaning, I think what SPACs are buying is just a function of the market, right? So I think of it as an asset class, and whether valuations are silly or not silly, that's a reflection of everything else going around going on around us in the world. So here to stay, yes, great, Gil. I think SPACs are here, and I think we'll continue to see more dollars go into the asset class and continue lineup of great sponsors doing interesting and different deals. And I'd say just because we think that EVs are the flavor of the month, you could look 6 months from now and it's a completely different world. You could have SPACs rolling up distressed oil and gas companies, or somebody figures out what to do to retail. It just, or somebody comes up with some other clever spin to do a 4-way merger with a SPAC, or it's somebody buys distressed bonds with I mean, it just, there's been a lot of creativity over the years. And I think with an interesting structure, dedicated investor base, and a lot of smart bankers and smart sponsors, you can be pretty darn creative with what you can do with the structure.
I'm definitely happy to hear that David is finally ready to refer to this. Much better. Eric, does that make you feel much better? Where do you think this is going?
No, I agree. I largely agree with David. I think this is to repeat what we've said. It's become institutionalized. I think there will be ongoing strong issuance. One of the things we didn't really touch on was kind of the whole Robin Hood effect, which seemed to kick in as part of the euphoria back in, say, May, June, July, really around the EVs and some of the other kind of high growth, high hype stories. And a little bit of that froth has come in. And I think that's a good thing. I think, as David said, having real companies, having companies that are thoroughly vetted by buy-siders, by institutions, I think only stands to improve the product and the perception. So having strong businesses, sustainable, enduring businesses that choose to go public this way are only going to be better for the asset class. And again, I don't know that we, without some meaningful new entrants on the IPO side, that we grow this market to 100 or 200 billion of annual IPOs. I think 60, 70, 80 billion, perhaps we stay at these levels, maybe it grows some, but I think there is some fatigue. I'm fairly sanguine on the back end, where I'm hearing pipe fatigue right now. I think that I'm more optimistic that we'll see kind of mega growth in terms of new entrants, because just as the Fidelities and Wellingtons and Blackstones and Apollos weren't there in a big way a couple of years ago, I think there are plenty of multi-100 billion and trillion-dollar institutions that have yet to dip their toe into the pipe market. And given, again, the institutionalization of the space, I think we'll see additional players come in. And the other thing I'd point out is that we've seen some corporates get involved, and some companies who have played some of the pipes in the EV space and elsewhere. So, and we had a forward purchase agreement for the company we underwrote for Ascended in July, where they had a $250 million FPA from a publicly traded company. So again, corporates who want to have minority interest in exciting companies, they may start getting involved in the space as well. So again, I just think there'll be an ongoing flow of capital with periods of digestion, and again, thorough vetting of companies. As Gil, you've said, anyone is free to redeem. People can vote with their pocketbook. But again, I think this is a sustained market for the foreseeable future.
Gary, what do you think? Where are we going?
I don't know if I bring anything materially different. I think the product will be here to stay. I don't think that the level of IPO activity next year will be the same as this year. Just if I had, just to venture a guess or make a bet. But I do think I'm excited for the transactions. I'm more excited. I'm less excited. Let's focus on the IPOs and more focus on the back ends. Like, I'm more excited about the types of companies that will go public beyond EV, businesses, real businesses that one could never have thought that we're going to go public through a SPAC vehicle, that are going to go public through a SPAC vehicle.
I think
This is
Gary,
great.
did you just freeze up?
I think Gary did freeze.
All right, so I'm going to
Two
finish this
slides.
up. I want to thank everyone. Oh, Gary, you froze up. I apologize. I jumped.
Yeah.
All right, so thank you very much. Closing words, just a comment. My bull case is much more aggressive than everyone else's, than I think, you know, you're hearing. I personally think this is in its infancy, given that it's a structure that has a humongous amount of application for it. Teaser for like the SPAC panel part 2, whenever we're going to do that. You know, a disintermediation of the banks. Companies that want to go public no longer have to get in line at the banks in order to get their deal done. You can show up at one of these SPAC franchises, Michael Klein, Chin Chu, the Eagle franchise, Gary Julien and his partners, Schulte, and you can take your company public in that way. I think the market is seeing the benefit of that disintermediation. I think private equity firms are going to want a SPAC on the shelf at all times. The ability to take their own portfolio companies public. It's going to be something where they're going to have to rationalize conflicts of interest. We just saw Tillman Fertitta do it with his Golden Casino, you know, asset that he took public via reverse merger with his own SPAC. But it will be a tool that will enable private equity firms to take their companies public when they want to take their companies public, you know, again, as opposed to getting on lines at the banks. David referenced the sophistication of all the players that are now surrounding this asset class: sponsors, private equity firms, bankers, investors. It's incredible. It's just an appreciation for a process and a product that really solves a lot of questions that have been in the market for a long time. So that's my last, you know, comment. If anyone else has anything more, Lawrence, I don't know how we finish this, but that's
That was great, Gil. Thank you very much. Really appreciate the discussion, everybody. Gil, Gary, David, and Eric. Maybe I'll share my enthusiasm, but as my wife will attest, I'll put a little bit of a rain cloud on it at the same time. I think these SPACs are amazing, and we're all super excited about it because the stock market's been on a 10-year tear. And I think we'll see SPACs take a pause if the stock market takes a pause. It is simply another vehicle of the markets. And we've got such a volume right now for the market to digest. These days, the market thinks that you need essentially $1 billion market cap to worth being public. It's not worth being public if you're a $100, $200 million market cap company. So that's a lot of unicorns and a lot of money right now out there chasing unicorns. So as long as the stock market's humming along, I think these SPACs are going to have a great run, and a lot of the people that are out there have a great time. And I hope the stock market does run for a long time. But this was great. Everybody, thank you for joining. We are having another event next week on distressed debt. That one is going to start at a different time. We're starting that at 7:30 p.m. at the request of a lot of people. It seems like in the distressed debt world, prefer to do things after dinner. And didn't want to do it from the trading desk. I guess a lot of them are actually in as opposed to home, which we see a lot of people here. We'd love to hear more ideas from people. Jake, Lisa, and I are trying to work out the 2021 calendar. So if you have ideas, please bring them in. We thought SPAC was very timely, and we're really very lucky and thankful for the expertise of again, David and Gary and Eric and Gil giving their time today. Thank you so much for a great discussion, and we look forward to seeing everybody next week. Again, remember, YU does do this because we want to keep everybody educated and involved, but we really do want you to be involved, helping our students. This COVID world is funky. Getting internships is difficult. You'll see on the links a link for MVP as a way to mentor the students. Please do so. And if you've got some internships or job leads, please reach out to Career Services or me, or the link that you see at the bottom of the page. This is a community that is well beyond just the YU alumni. Everybody is welcome to come in and learn from these sessions, but we do again ask that you please try to help the students. Have a great day, everyone.
Thank you.
Thank you.
everyone.
Thanks.
Well done, guys. Dave, Eric,
Thank you, Gil.
Thanks so much,
Bye-bye.
Gil.
thank you, guys. Much appreciated.
Thanks.